Hello, good afternoon. You've tuned into Mutual Fund Corner on CNBC-TV18 and I'm Vinny Motiwala in the Mumbai studio. Flows, let's talk about that, right? We recently had the AMFI data that came out for the month of November and that seems like some bit of a moderation that we're seeing coming in. Fund flows, equity fund flows that came in at 35,927 crores, while the flows on sectors as thematic funds, that saw some bit of a drop in the month of November on a month-on-month basis. But today what we're going to talk about is not only month of November, but how was the overall industry trend for the calendar year 2024 in the mutual fund industry. We've seen some bit of an outperformance, right, that came in from large caps, flexi cap, multi-cap funds versus the benchmark indices, versus the equity markets. Today we'll talk about all of that. Plus, we'll talk about what are the trends that are expected in 2025. We have a guest joining in with us. We have Niranjan Awasthi, who is the SVP as well as Head of Product and Marketing at Digital at Edelweiss Mutual Fund. Niranjan, thank you so much for joining with us on the show. It's a pleasure having you here. Exciting year, right, for mutual fund. It's not been a bad year. We have seen those record high SIP numbers that have come in. Flows have been decent, except November was a bit subdued. But let's talk about overall what were the trends that you saw in 2024 in terms of the calendar year. Was there enough retail participation in 2024 coming in? Has that seen an increase? How was it?
I would say it was an amazing year. You know, just putting things in numbers, which was calendar year 2023, we ended with 50 lakh crore AUM. Today in November end, we are sitting at almost 68 lakh crore AUM, a rise of 18 lakhs. Just to go back in beginning of 2017 somewhere, the entire industry AUM was around 17-18 lakh crore. So we added what we were just few years back, the entire size in a year. But what is more heartening is to see the retail inflows and the rise in numbers. So we added almost 1 crore new investors to the industry. We crossed almost 5 crore unique folios. In terms of folios, it has been one of the fastest growing year with almost 4 crore retail folios getting added into the industry. Within this, if you see equity, total overall, number of folios were 5 crores. In equity, it was 4 crores. Within equity, thematic funds actually scored the highest. They went up by almost, 1.2 crore folios, 1.3 crore folios. Passives was again, kind of dark horse. Passive number of folios went up from almost 2 crores to almost 3 crores, which was a huge number. And within that, I think so index funds where people have started investing in, lock, stock and barrel, index funds saw a rise of almost 90% in terms of folio count. So overall, I think so it's been a great year. Retail investors continue to show confidence in equity funds specifically. At the same time, on the debt side, I think so the number of folios have come down while the overall flows have stabilized, of course, because of the taxation change.
But equity, surely that has been an exciting space, and equity fund, like you're mentioning, is also, that is an improvement in terms of folio numbers right now we're mentioning also. It's a very good participation that we're seeing. What I want to understand is which fund categories do you think that outperformed in calendar year 2024?
Right.
And what were the factors that actually contributed to their success? When you talk about even a thematic fund, or what was it that led to this strong performance that we saw in this outperformance in some of the categories?
Right. So when we talk about diversified funds based on market cap, mid-caps definitely scored the highest. They outperformed all other funds. So large cap on the other side, calendar year, till November or till date, if you see, they clocked almost around 18-19% returns, whereas mid cap and small cap has clocked almost 37-38% returns. So definitely mid caps have done much better compared to any other categories. Mid cap, for that matter, it's been straight 5th calendar year where they have outperformed large cap funds.
Fifth year that they've outperformed large cap funds,
and that's the reason we have seen the meteoric rise in mid-cap funds and small-cap funds in terms of folios and AUM. So they continue to outperform. That has been one reason. The reason for mid-cap outperforming is, of course, the earnings growth. If you see last couple of years, the earnings growth in mid-cap and small-cap have been broadly faster than large cap. And generally we have seen when markets are bullish, economy is doing well, mid caps and small cap tend to outperform. Even in the expected earnings growth over the next 2 years, mid caps and small caps, the expectation is will be growing at least twice the rate of what the large caps would. Within thematic, if you see, themes like IT, technology continues to do well. On the laggard side, I think so consumption sector has not done well. MNC funds hasn't done well. So there have been, like always, dichotomy between which sectors would outperform, which wouldn't outperform. They have been, on both the sides.
Absolutely. There's always two sides to a story and two sides. There are two wheels always running a cycle as well.
Absolutely.
So yes, we have to see some going up and some going down, but consumption surely was nothing exciting this year, at least coming in on that front.
Yeah.
Market volatility was also there. There was good enough volatility. We had a lot of events that we were watching out for. But how does market volatility influence this behavior that you have of an investor, and how did that impact them in calendar 2024? Any specific trends that you noticed on that front?
Right. So volatility has been there, but it's not been a meaningful volatility because one is standard deviation, but for what matters to investor is drawdowns. If you see, since COVID, we haven't had a year with huge drawdown. When I say huge drawdown, it is basically more than 30%. So it was only in COVID year 2020 we saw that. In 2022 there was a bit of drawdown of almost 15-20%. But barring that, over the last 4 years, the max drawdown we have seen is just around 10-12%. Even this year, the recent fall, people say it's a correction, but it was just 10-12%. It is not a meaningful correction. Usually we have seen when a correction of almost 10-12% occurs, people who are waiting on the sideline tend to jump into the market and buy more units, whether it is equities or direct equities or through mutual funds. They tend to invest more to average out their purchases, and that's what we have seen. So, but
does that happen a lot more? Because it is interesting, right? You see the market fall, you always get excited. Is that something that one should be doing, looking at the drawdowns that you've seen in the past?
So generally the behavior is good, that when you see market fall, you tend to invest more, and you should be investing more because you average out, especially in a year where we haven't seen meaningful corrections and it's a one-way rally. Every correction gives you an opportunity to reduce your overall cost, and that's where rupee cost averaging works. So it is good. What is more important is if there is a 20 or 30% fall, which may happen in a good bull year also. We have seen 20-30% fall. You should not be scared. You should not be afraid of putting money even during those periods. So if you have say 100 rupees, you have invested 50 rupees of that after 10% correction, keep the remaining 50 rupees as well. Be more opportunistic. If there is more fall, invest that. Don't be afraid after 20-30% fall, because we have seen the first 10% fall, people are very excited. The next 20% or 30% fall, people get scared, and then either they leave equity and never come back. But that's not the right way.
That's not the right way. So just want to sum up this answer in terms of drawdowns. This year was not as bad as we've seen in the past since COVID, right? It was still manageable in terms of a drawdown. Not a bad move coming in on that front. But this is all we spoke about 2024 right now. I want to wait and watch now what is going to happen in 2025, because I have a lot of questions for you on that front. But on that note, we'll take a very short break, viewers. Don't go anywhere, because on the other side, we're going to be talking about 2025. What is the industry looking like? So stay tuned in for that.
From sharp insights in the political arena to all the excitement from the world of sports. CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18. Now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18. Now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive
Mutual fund. Now he's going to talk to us about what are we expecting in 2025 in the industry. I'm all geared up for that. Niranjan, 2024, you said, okay, fine, index funds did well. Thematic funds, we talked about that as well. So let's start by actually talking about just the basics. What are we expecting in terms of a trend for the calendar year 2025? What are we watching out for?
Right. So last 2 years, 3 years, we have seen mid-cap, small-cap, thematic funds doing well in terms of flows and investors flocking into these categories. I think so this year, because markets may narrow down, the law of averages would play out. Specifically when markets narrow down, return environment is moderate, you would see people coming back into the dal chawal funds, like whether it is diversified funds, multi-cap, flexi-cap funds, or even large-cap funds for that matter. We may see investors getting their portfolio shifted or tilted towards these. At least a newer allocation may come here. On the other side, people who are less in terms of risk-taking capacity, hybrid funds or balanced advantage funds, which people have kind of forgotten after 2016-17, may also see some sunshine, and people may allocate more money towards these funds as well.
Okay, so enough with biryanis, enough with eating outside food. Go home and eat dal chawal. That's going to be the trend that we're watching out for in 2025. I want to talk about an interesting one that, what also not a lot of people talk about is passive investment. I want to see, will passive investment like ETFs, index funds, continue to gain that traction? Index funds, you said that has picked up some pace, right? So is that something that will continue in 2025 without a doubt, and that would be something like an outperformer that could be possible?
So it will continue, but it may not come at the cost of active funds, because at the beginning we saw one trend which we have seen is calendar year 2024. all categories except small cap has outperformed their benchmarks. So there is a good alpha to be made within active funds as well. At the same time, passive funds are also picking up. So what probably investors are doing is they are not shifting, but they are adding passive funds also to their portfolio. So it is not one at the cost of the other, but people are adding flavor of passive funds into their portfolio. Specifically, we have seen, at least in the retail segment, index funds is picking up, and within index fund, people are trying more smart beta oriented products, whether it is mid-cap momentum fund or alpha low vol kind of funds. People are adding to their portfolio, and there we may see that passive is picking up. But overall, the way people are being made aware about passive funds, their benefits of being low cost, their benefits of being not the outperformer or not even be the underperformer compared to the benchmark.
It's less riskier, you could say, right?
See, end of the day,
equal risk? Like
the risk is equal because end of the day they are equity funds. So what risk equity has in any other fund, here also the risk is same. But what it helps in is basically in an active fund, you may see 1 year it is outperforming its benchmark or peers, the other years it may underperform also, whereas benchmark or index fund is in line with the benchmark. So it adds some stability to your portfolio when you compare that with the overall markets. Plus, emotionally you are not tracking it day in, day out, whether it is rank 1 or rank 10, which helps you stay invested through the course. So passive funds have advantage beyond cost. These are some of the advantage, and people are starting to realize this.
Okay, so surely there will be increase in passive fund investments also, but active will continue to be there.
Absolutely.
It is just that they will add more to their kitty is what we're watching out for.
Yes.
So yes, that's a trend. But specifically in terms of sectors, themes, that was a trend, right? At one point of time, mid-year, I was like, thematic funds is what everyone was talking about, wanted to know about this as well. What is it that is looking like in 2025 for thematic funds? Do you think, that could be a promising bet in 2025 going forward, or is that something that is going to die down now?
So the peculiar thing of thematic funds is they keep rotating. And for every investor, it is important to get into a thematic fund at the right time and also exit them at the right time, because they are, satellite part of your portfolio. We have seen, tech funds and all may continue to do well in coming years. We may see internet kind of, products or thematic fund which are narrower may continue to do well. Consumption could be a turnaround. This year, consumption as a theme has not done well, but there could be a revival, and consumption as a theme, banking sector for that matter, may see some revival. So there could be shifts from maybe defense-oriented sectors or PSU-oriented sector funds to these sectors, whether it is consumption, IT, internet economy, and so on.
Consumption, IT, internet economy.
Yes.
I'm just worried because right now when you're talking about consumption 2024, all we hear people are talking about, slowdown, growth and all, but consumption surely something is expected to pick up. Even managements are highlighting that, this is just not a structurally decline that we're seeing coming in. So yes, watch out for the consumption side. That is something as an NFO or even as a thematic fund that could see a pickup coming in. Niranjan, let's talk about this. Now, for risk-averse investors, if they want to avoid that, what type of funds would you recommend that they should be looking at? Given the economic outlook for 2025, what is it that they should be, that they're going to have a safe bet, that they're going to be like, okay, I don't need to worry much, whether it's themes or index funds, what is it that they should be looking at?
See, one thing is very important to understand, that we are in a multi-year bull market, and that's not a secret. Everyone knows this. Now, but risk-averse investors could be in the dilemma that they want to participate in equity, but at a lower risk. I can't think of any other category than balanced advantage fund for such investors, because what it does beautifully is when markets are doing well, they will enable you to participate in that rally. At the same time, if there are any correction or drawdowns, they reduce your volatility, they reduce drawdowns in your portfolio. So balanced advantage fund continues to be the best choice for investors who are looking to invest in market but are risk averse.
Okay, balanced advantage fund is what you're highlighting. But other than that, if I had to go for something, then what should one be looking at? Like, is it that something that you should avoid thematic funds. There are a lot of conversations that go around that, right?
Yeah.
Right now, everyone's talking about like maybe a theme may not do well. So how
Yes.
do you judge that point, right? Like you said right now that you have to exit at the right time. But how do you know the entry point also of someone who wants to enter at such a point? Maybe make some money but not take that big risk. Is that something, there's a possibility on that front?
So there are certain funds which help you doing that, like business cycle funds, the one which we launched recently 2-3 months back. These funds do sector rotation within their portfolio, so you don't need to pick which sector would do well, exit a sector which may not do well. The fund manager does it for you. So if you want a flavor of sectoral funds in your portfolio but you are unable to take those calls, maybe balanced business cycle fund is a better choice for such investors. But if you are still getting into a sectoral fund or a thematic fund, and if you are not able to judge what would do well, which one to exit, then best of luck. I think so. They are not for you, honestly.
Okay. And just one more follow-up on this one. Mid and small cap funds, is that something that one should look at as well right now in 2025? Risk averse or not is fine, but is that something that would be
mid cap and small cap has to be part of your core portfolio, because that is where the growth is. That is where the newer blue chips would emerge from. The best approach for these kind of segment, and we have been talking about it, is through systematic investment plan and in a staggered way investing in them. You can't stay out of mid cap and small cap and make money in India. You have to be in that segment. The best possible way is to keep investing in these segments.
Okay, so SIPs, keep investing slowly and steadily in the segment. Niranjan, important one is, what role is international funds going to play, especially in an investor's portfolio in 2025? Does that become a necessity to add, or how should one be viewing this?
Right. So international fund as a part of diversification for some investors who want to have dollar assets in their portfolio, it is important. But today, we are in an environment where the correlations of different countries and asset class may change, because what US does with their rates, what happens to US dollar will define a lot. I think so within diversification from international perspective, US remains a better bet for a lot of investors, US economy. So people can continue to invest in international funds, but unfortunately very few funds in India are allowed to be taking money. We have one of the widest basket of international funds. We are accepting money, but I think so US tech focused or US focused fund continues to be
but even after
choice.
We'll be seeing a new president coming in from January and everyone anticipates God knows what restrictions and everything. Is it easier to handle this volatility or that may come up, or how should one be? At which point in 2025 should one start looking also at that fund then, international funds?
Right. So international funds, again, it's very difficult to time entry and exit. If you're looking for international fund as an asset allocation, it should be a strategic asset allocation and not a tactical asset allocation. For strategic, US, as I said, one of the largest economy in the world, has almost 40-45% market capitalization share. Nothing can go wrong in the long run, right? As far as diversification is concerned. So US continues to be a good bet for such investors, but they can start investing in a staggered way. Of course, valuations like in India, US also is not cheap anymore. So I think so a staggered approach to invest in international funds would be a better approach.
Okay, staggered approach for international funds. But Niranjan, it has been a great conversation. Thank you so much for telling us what to watch out for in 2025. What's going to be looking exciting as well. Index funds, consumption coming back, banking coming back, looking at those funds is going to be something interesting. So thank you so much, Niranjan, for joining in with us on the show. It's a pleasure having you. And viewers, it has been a great conversation. We saw how 2024 went, how 2025 will be. So yes, do take, informed decisions that you make as well. But that's all the time we have on this edition of MF Corner. Stay tuned in. Closing bell up next.
Krishnan sir, can you hear me clearly?
Yes, I can hear you. Yash, can you hear me?
I can. First of all, my apologies, sir. Just because of some logistical constraints, we had to delay the interview by about half an hour. I am so sorry for that. And I understand that you have a hard stop as well. Just one request, Krishnan sir, if we could keep the answers more quantitative, since this is the first interview after listing, in that sense. If you could keep the answers more quantitative and let the investors get a direction in terms of numbers where we're going, it would be great. And shorter answers also, so that I can accommodate more questions.
Sure.
Perfect, sir.
Always clear on. That's what makes it fun working with you.
Sure. Then I was waiting for this interview because I could understand that during the IPO, you could not give out numbers and forward guidance. So this could actually be the one where you can talk about, how you look at the numbers to pan out.
Got it. Got it.
Guys, can we start? Sir is a hard stop. Okay. Yes. 20 minutes. Thank you so much, Mr. Krishnan Ramachandran sir, for speaking to CNBC TV18. And I presume, after listing, this is the first time you're interacting to any channel. So looking forward to a great interaction. If I could start talking to you about the growth at the top line, at the premium level itself, as far as your net earned premium is concerned, in FY24, that had seen a growth of about 43%. So far in H1 FY25, that growth stands at about 37%. Now, what I want to understand from you is, as far as second half of the year is concerned, could the growth in terms of your NEP and GWP be higher than the first half? And if yes, what could be that ballpark number that we could be looking at as far as FY25 growth in terms of net earned premium and gross weighted premium is concerned?
Sure, Yash. Firstly, thank you very much for the opportunity to be on your show and to talk to you. Always something that I look forward to. Let me answer the question in terms of GWP, because NEP is something that is also a factor of various other elements. So let me not comment on NEP. And there's one caveat I'll make to the growth number that I'm going to talk to you about, which is that as you know, and as we all know, the regulator made a change to accounting in terms of accounting on long-term policies now works on a 1/n basis. So I will speak about growth on a like-to-like basis, because then you can compare what it means to last year, and last year was on a different accounting basis. So on a full year basis, as of H1, the health insurance industry grew at about 17-18%. On a full year basis as well, is that our expectation that the industry on a like-to-like basis will continue to grow at 17-18%. Our H1 growth was about 32-33%, on a like-to-like basis, and by the time the year is done, you can continue to expect us to grow. I'd say 8 to 10 points, at least faster than industry on a like-to-like basis. So I think just in terms of how we look at the rest of the year, Yash, this is how we look at it. Importantly, I would like to emphasize that when you look at headline numbers, you do need to make for this accounting adjustment, and the numbers I am quoting are on a like-to-like basis.
Correct. So just to continue that point, and only looking at the numbers on a like-to-like basis, how you had reported it last year, H1 FY25, as far as NEP is concerned, the absolute number is 2,231 crore that you've collected. GWP is 3,241 crore, that the number that you've collected in terms of the premium. By FY25, which means accommodating for the second half, are these two numbers possible? I am just going by how you've grown in the recent past and normalizing it. 5,000 to about 5,200 crore as far as NEP is concerned, and about 6,300 to 6,500 crore on the GWP side.
See, on a like-to-like basis, our GWP number would be upwards of 7,000 crores, Yash.
Okay.
So, we did 5,600 crores last year. As far as GWP is concerned, on the same accounting basis, our GWP for the full year should be upwards of 7,000 crores, which, as I mentioned, right, I expect the industry to grow at 17-18%. On a like-to-like basis, our growth rate would be 8 to 10 percentage points higher. So if you did 5,600 into 1.28, which is a 28% growth, you end up with a number that's about 7,000 crores.
Correct. The differential, sir, that you're speaking about, outperformance to the industry, do you expect that to continue in FY26 as well? Looking at every factor that comes into place, FY25, of course, you said that will continue. FY26 also, the differential of 8 to 10% is expected to continue?
Yeah, I think our objective is to clearly grow faster than market, at least for the next 3 to 5 years, Yash. What the exact differential is, I'll be able to quantify towards the end of the year, but we do expect to grow faster than industry.
Okay. So I want to understand from you right now, of course, you have the advantage of size playing for the company. 6,000 crore is what you said that you'll be able to do. 7,000 crore rather, you'd be able to do in terms of GWP for FY25 as well. At what point in your sense does growth start aligning with the industry? At what number do you think that the size is good enough for the growth to start aligning to the industry, according to you?
I'd say in terms of growth aligning towards industry, that number is probably when we get to upwards of 15,000 crores, Yash.
Okay.
I think at that point you can start to expect us to grow. Even then, I would wager that we'd probably grow faster than industry, but if you have to sort of put a number to it, it would be upwards of 15,000 crores. Upwards
of 15,000 crore. I think that gives fair bit of guidance in terms of how the company and the outperformance goes. One final question as far as growth is concerned. Slightly longer term view, 10,000 crore of GWP in the next 2 years and 10,000 crore of NEP in the next 3 financial years, possible?
10,000 crores in the next 2 years. Plus minus 5% possible.
Okay. So one question as far as expenses of management is concerned. At the end of H1 FY25, that stood at about 40%. We all know that the regulatory compliance requires you to bring it down to 35%. I believe you've put in a request with IRDAI to give you some time to comply with that. What is that time limit that you've sought from IRDAI? And I believe there are certain hearings which are going on at the moment at the regulator's desk. How soon do you expect an answer from the regulator in terms of getting that approval?
So honestly, not in a position in terms of the regulatory comment on this, Yash, but what I can confirm, again, on a like-to-like basis, is that by FY26, we are on the path to compliance. Obviously, there's a change in terms of the accounting. So we have submitted our position to the regulator that there has to be an adjustment for the accounting change. But on a like-to-like basis, we are on the path to complying by FY26.
By FY26, just if I could take that point a little forward, FY26, the expenses of management comes down from 40 to 35%, as you stated. That 5% of reduction in the expenses of management